All right, my friends, so how you hold your investments will play a significant role in the taxes you pay. Don't make the mistake by being ignorant about where to place your assets. This is called asset location, and it's a critical factor of your retirement planning and investment management. They go hand in hand. So let's dive right into this. Take my purple. Oh, looks pretty good there. So we're going to draw 3 buckets. All right, good. Looks like you can see that pretty good. All right, so we got 3 buckets. We're going to have a taxable account. We're going to have a tax deferred. And we're going to have a tax free, which will be a Roth. Now, we're not using life insurance or variable or annuities here. No life insurance, no annuities, just good old-fashioned investments. All right, so what we're saying here, let's just say we got $1 million for simplicity. Let's say $100,000. We'll make it simple, $100,000. What a lot of people will do, and this I've seen this a million times on Sunday. So you got $100,000. All right, and we're going to say you got $50,000 in here, and 25 here, and 25 here. All right, so what a lot of investment advisors will do is say, look, you're a 60-40 stock to bond, or we even say 50-50 stock to bond. That's what we'll do. We'll say 50-50. You're a 50-50 investor. 50% stocks, 50% bonds. And what they'll do is they'll put $25,000 in here. They'll have 12.5, 12.5, 25, 25, 25, 12.5, and 12.5. So they'll do 50-50 across the board. I cannot tell you how many times I've seen this, and this ticks me off. It infuriates me. All right, so the problem with this is that this right here is a stocks. This right here is a stocks, and that's the stocks. Stocks are always, other than short-term capital gains, qualified dividends and long-term capital gains are always and everywhere taxed less than ordinary income. So anything that comes out of here is taxed as OI, ordinary income. That's your tax deferred, your 401k, IRA, it doesn't matter. Anything that comes out of here is taxed as ordinary income, OI. Let me erase something here real quick. All right. So that's not good. We don't want OI. We want to minimize OI. But Josh, how do I minimize OI? Bear with me, my friends. Don't get paid. Don't get too Russian. You got to stay patient. I'm going to show you. Make sure that's dry. All right. Now, in this account, this right here is taxed at OI. That's bonds. Or it's taxed at 0 if it's tax exempt, municipal bonds. All right. This right here, most likely, and this is short-term capital gain because you're doing a lot of trading, is taxed as QDI or LTCG. So this is OI. All right, so basically what's happening here? We have this anything is in this. It doesn't matter if stocks or bonds. Either come out or taxed as OI. The 12.5 is taxed as qualified dividends or long-term capital gain. Both qualified dividends or long-term capital gain are taxed more favorably than ordinary income. All right. Now you could have municipal bond income. Don't do that. I'm going to share with you why. Even though municipal bond is tax exempt, people say I should have tax exempt income. No, you're making a huge mistake. What comes out of your Roth, of course, is tax free. Well, I just say 0. There's no tax. 0% is tax free. So the Roth is obviously beneficial. All right, so you see how that's shaking out so far. So what we want to do here then is we're saying, here's our stocks in the IRA. Here's our stocks here. Which is more favorable from a tax perspective? Stocks in your IRA or stocks in your taxable account? Want to take a guess? It's right here. Stocks in your taxable account because it's taxed as QDI or long-term capital gains. And these could be 0, 15, and 20. 0, 15, and 20, and then you add the 3.8% Obamacare surtax if you need, net investment income tax. But that's only if you have income if you're over $200,000 single or $250,000 married filing jointly. This will be 10, 12, 22, 24, and so on and so on. So anything. So basically, if you are here, if you're in the 10 to 12% tax bracket, you won't pay any long-term capital gain or qualified dividends. If you're on the 22, 24, it'll be 15, and I can't remember 33. I think 33 is also the 15%. And if you're above that, it'll be a 20. So every single time, qualified dividend income, essentially you're owning stocks that are invested in a bank or something like that, or what's a good Apple's got a dividend. That's qualified dividend income. That will be taxed every single time lower than ordinary income. Every single time qualified dividends will be taxed lower than ordinary income. So by having stocks in your IRA, you're literally converting what was a more favorable tax treatment to a less favorable tax treatment every time. Now people say, but Josh, I have to pay taxes when I have that account anyway. There's a 1099 at the end of the year, 1099 dividend, 1099 int, 1099 dividend INT, and I forgot what the other one is. Well, no, you don't. If you have an ETF that doesn't have, Vanguard ETF, you might have some dividends in there, but you have growth-oriented ETFs. You don't have hardly any dividends, and there's no turnover in terms of capital gains. So you do not need to pay taxes on here, because the argument is, at least I'm getting tax deferred here. At least I'm not where I'm not having to pay 1099 income every single year in this account because it's a tax deferred. Well, you don't have to get 1099 income in this account if you manage it correctly with an ETF, an exchange traded fund. You just get a Vanguard VOO and you're done. We have a little bit of dividends, probably. Is it going to be much? Probably not. But either way, it's still more favorable than what is coming out the pike later on down the road, which is ordinary income. And if you get a growth-oriented ETF, there's not going to be hardly any dividends, if any whatsoever. So anyway, what you're doing by having bonds or stocks in your IRA and then no stock, and then what you're doing with stocks in your IRA is you're taking was more favorable tax treatment of stocks and making it less favorable to you, more favorable to the IRS. Absolutely. On top of that, what you're doing here is you're buying a municipal, if you're buying a municipal bond or if you're buying a corporate bond, it doesn't matter. Corporate bonds tax at ordinary income. All right, so let's go back to this here real quick. So did I solve the riddle with stocks? We don't want stocks in our IRA. We want stocks in taxable accounts. We'll get to Roth here in just a second. But now we also got 12,500 in bonds. So corporate and government bonds equals ordinary income tax. Municipal bonds equals tax-free, all right, for the most part. I mean, there's some sort of municipal private placement bond stuff, but anyway, just tax-free. So a corporate bond, we'll say, pays 3%, but a municipal bond is paying 1.75. Well, we'll just see, all right. So if a corporate bond is your tax at, we'll just say 22% tax bracket minus 22%, what is your net corporate bond tax? So we got 3 minus 22%, 2.34. So even after tax, and we're paying ordinary income on that tax, if I'm getting 3% on the corporate bond after tax, my after-tax yield is 2.34, which is significantly higher than that right there, the 1.75. In fact, 2.34 minus 1.75 divided by that's an over 30% increase in yield, even factoring the taxes have to pay. So a lot of people make this mistake. So say I'll have municipal bonds because it's tax-free, not realizing that corporate bonds, even minus tax, is going to be paying a lot more, generally speaking, than municipal bonds. And people make that mistake all the time. So no, we don't want municipal bonds in our taxable account. It doesn't make sense. Now, can you find deals on municipal bonds? Sure, absolutely. Our friend out in California, he was getting some 5% tax-frees in California. I mean, you can't beat that. Are you going to be able to get those today? I guarantee you can't, unless you're paying a pretty significant premium. All right, so we don't want tax-exempt bonds. I mean, again, this is a generalization. There are cases where it makes sense, but we don't want tax-exempt bonds. And remember, tax-exempt bonds are part of your provisional income rules too. So don't think I'm going to reduce my Social Security taxes because I own municipal bonds. No, you're not. You're just not. The tax-exempt bonds are part of your modified adjusted gross income. They're certainly part of your provisional income as well. Your provisional income as well. So no munis. All right. Now, but however, what happens here? So now what we've done here. We got ordinary income on these bonds, and now we have ordinary income on stocks. Does that make sense? So essentially what we've done now is of the four, we got 1, 2, 3, 4. three of those, and we have we'll just say QDI, long-term capital gain. QDI LTCG. All right, so we got 4 different accounts here, stocks and bonds, in 2 different accounts. We got stocks, bonds, stocks, bonds. Of those 4, 3 are going to be taxed as OI, ordinary income. So we got ordinary income, 1, 2, 3, and we got 1 long-term capital gain qualified dividend. That's not the right answer, because again, what we've done here is we're taking what was going to be taxed as ordinary income, taxed as qualified dividend, and we're putting it taxed as ordinary income. We don't want to do that. Don't make that mistake. So what we want to do instead, I think I've solved the dilemma if we should have municipal bonds. I do believe that. I think I've challenged you to some degree that when we have stocks inside an IRA, we've taken a taxable, tax favorable treatment of an investment and we've made it tax less favorable. So what we want instead is we want, what do you have, $25,000. We want $25,000 in stocks, all right? And then here we had $50,000 total. And here, what do we have? We had before we had $75,000. Yeah, we had $75,000. So 75,000 divided by 2. So we're going to have 25. All right, so we're going to have 37,500. No, hold on just a second. Minus 12, minus 25. We're going to have 12,500 in here, stocks, and the rest would be bonds, which would be, was that 20? We had 75,000. So hold on just a second. Plus 25 minus 75, 37.5 in bonds. Okay, good. All right, so now what we have now, we have 3. We got 1 as QDI and 2 as ordinary income. All right, so we've eliminated 1 ordinary income taxable consequence now. We said we're not going to pay tax on that ordinary income. We're going to get in the Roth in here in just a second, all right? So we're saying we got 25, so we're still a 50-50 investor. We're still 50 and 50. So we haven't increased our risk tolerance at all, but what we've done instead is we've said we're going to make this more tax efficient. We still need to have 37,500 in stocks, but we're going to put the bulk into our taxable account, and we're going to have 37,500 bonds. And of course, those will be all corporate bonds because they all come out as ordinary income. So essentially, we're immediately giving ourselves a tax cut. Immediately we have, because we have 25,000 now taxed as QDI, whereas before we only had 12,500 taxed at QDI. Does that make sense? So literally now we have on 75,000 we had 37,500 plus we had 40, basically 50,000. Yeah, man, we had 37,500 in bonds, plus we had 12. No, we didn't have 30. We had 25 plus 12.5. I can't remember. But anyway, we had 3/4 of the $75,000 was taxed as OI. Now we don't have 3/4 of it. Now we have 25,000 over 75. We have 2/3 of it, right? Yeah, so we got 2/3. So before we had 3/4, we had 75% tax as OI. Now we have only 66% tax at OI. The rest is taxed at QDI, which is good. All right. So now what we want to do, though, we got to incorporate the Roth. So let me show you something else here, too. Don't forget, this 20, let's just keep going. We're going to incorporate the Roth. All right. So now we've changed. We have 100% stocks in our taxable account, but we still have 12,500 in stocks in this account. Now we incorporate the Roth, we have 12,500 in bonds, all right? We don't want 12,500 in bonds because bonds should never be in a Roth. They shouldn't be in a Roth. So what we want to do is we want to move these bonds over here and these stocks over here. Because what we want to do, this is complete. So we got QDI, OI, tax free. So we want to move those bonds to this account and move those stocks to that account. So what we're going to do is we're going to have, oops, I just erased all that. Is we're going to have 50,000 bonds, 25 stocks. All right? So we're back to a 50-50 portfolio. We still have 50% stocks, 50% bonds. But in this case, we have OI, we have TF, and we have QDI. So now we have 50% of our portfolio is only OI, whereas before 66% of our portfolio was OI. Before that, 75% of our portfolio was only OI. But now we have a third of our portfolio was at a fourth of our portfolio is tax-free, and a fourth of our portfolio is qualified dividend income, and that's beneficial. I mean, that's how you should have it without question. Now here you want your dividend payers, your REITs, and if you're ever going to have bonds, be high yield. Here you want your small companies, growth, and growth stocks. No dividend payers. Now look, this is, if you have dividend payers in there, am I going to scream to help? No, I'm just saying at the end of the day, ideally, we have no transactions, no taxable gains, no 1099 income at all, which is small companies in particularly, because usually more small companies don't pay a dividend. We don't want any turnover. We just don't want dividends. And growth stocks and small caps generally are the least ones that are going to pay a dividend. Here we're going to want to have dividend payers, large companies, because the dividends all come out tax-free here, right? So even though QDI is better than OI, well, this is better than all of it. Tax-free is better than QDI. QDI is better than OI. So essentially what we've done now is we've taken our stocks that were initially taxed as OI, we made them taxed at QDI, but now we're saying, screw that, we're going to have them tax-free. And now what we have with stocks that before were taxed as OI, they might be taxed as QDI or long-term capital gain, but it won't be, because these small companies with growth hardly have any dividends, and because they're ETFs, there won't be any transactions in terms of short-term capital gain or long-term capital gain. Now we have all corporate bonds too. So we no longer have any municipal bonds, all corporate bonds, and that's just, I mean, that's the way it works. So we've done, again, we've used 50% OI. We used to have a good amount in QDI. Now we don't have anything in QDI. You'll probably get a little bit, but not much. And we used to have a bunch of bonds in tax-free. Bonds give you no growth. So now we no longer have bonds in tax-free. We just have growth-oriented stuff that pays a dividend, which is great. Now the benefit here too is, don't forget, this entire $25,000 grows, transfer tax-free to heirs. All right, so this entire this entire $25,000. So if it grows to $100,000, the entire thing transfers tax-free to heirs because of the step-up basis rules. I start with a $25,000 cost basis. I die, it's worth $100,000 because of appreciation. My kids get $100,000 and step up as their cost basis. They can sell it the next day and not pay any taxes whatsoever. Same thing here too. Another reason we don't want bonds, we want this guy to grow as much as possible because that transfers tax-free as well. Because this does not transfer tax-free, it'll grow to $66,000, let's just say, it still comes out as ordinary income. So now what we've done is we increased our momentum, our earnings here to transfer tax-free, reduce our own taxes, reduce the taxes to our heirs. Reduce our own taxes, reduce the taxes to the heirs, because this transfers tax-free, this transfers tax-free, and because these are growth-oriented investments, we're going to get the most bang for our buck. Lastly, because bonds don't grow hardly at all. I mean, they're going to reinvest the bonds. Well, whoop-de-doo. So you might get 3%, 2%, something like that. Let's just say 3. It grows to $66,000. That is all taxed to the heirs on the first dollar as ordinary income. $200,000 transfers tax-free, $66,000 transfers taxes OI, ordinary income. Asset location. If you don't, you're paying way too much in taxes. If you have a broker or a guy, financial guy, or a fiduciary, and they're putting you all in the same asset allocation with your stock, with your traditional IRA, your 401k, your taxable account, and your Roth, you got to find something new that God doesn't know what He's doing. It's just no other way around that. All right. Hope this helps. Smash the like button. I'd like to hear what you think on this. It's a big deal. So don't forget to subscribe. Hit the bell for notification. And, of course, give me a thumbs up. We'll see you.